Welcome on back to another Meet Kevin report. We are on episode 125. It is July 18th. Did you know that we have an email newsletter now that you could sign up for totally for free? Daily Insights. Click the link in the description and check out that link for the daily newsletter. You can find it on YouTube or meetkevin.com for that description. Okay, so let's get started. We've got bank earnings this morning. We've got Tesla earnings tomorrow. We've got a market that is potentially convinced that maybe, quote unquote, this time is different when it comes to the yield curve inversion. And after all, what are the four most dangerous words in investing? This time is different. But we'll talk about that in a moment, as well as some data coming out. First, let's look at Morgan Stanley. Morgan Stanley coming in with a revenue beat at $13.46 billion versus the $13.11 expected. They did have an increase in credit losses that were up 59%, especially as related to institutional losses and potentially office revenue losses. We go in a little bit to what Wall Street is looking at. It looks like the thesis was that the headline numbers were relatively okay at Morgan Stanley, leading to some volatility once the details started coming out, including some of those allowances and margins, as well as some other revenue that may have propped up some of those headline numbers. The provision for credit losses did include their total provision for credit losses includes institutional securities. But still 59% increase in the provision for credit losses. They saw a decrease in advisory revenue thanks to fewer completed transactions, an increase in investment grade bond issuance, and higher convertible offerings that they worked on. And you've got, let's see here, severance costs of $308 million. Shares, a lot of volatility here in the shares. A wealth management revenue coming in at $6.7 billion, up 16%. One of the things you're noticing is a lot of these banks are now saying, hey, we want to move away from just trading and focus on wealth management. This is basically where you're looking for folks with a higher net worth, ideally, to invest their capital on their behalf. It's sort of like going to a financial advisor and saying, please invest my money for me. I don't know what to do. And then bank employees do that for you. That's the wealth management division. Equities trading came in at a 14% decline. And let's see, looking at a little bit more here. Yeah, a little bit of volatility there on Morgan Stanley. You've got B of A coming out with their earnings call soon as well. So this gives you a little bit of a heads up on on Morgan Stanley. Let's look at Bank of America and see if we can get a little bit of a quick preview here. But so far, it does seem like you're getting a lot of positive results coming out of our initial earnings sets, which maybe just because expectations are so low. You've got very, very low expectations for earnings across the S&P. Even the S&P 500, I think you're looking at somewhere around a -5, might actually be closer to 8, somewhere around an 8% earnings decline is the expectation. Let's see if I have that handy here. Yeah, here it is. Change in S&P earnings. Oh, okay. Yeah, here it is. Okay. Analysts estimate that earnings per share at companies in the S&P 500 will fall by about 8.1% from a year ago. And net income will fall by somewhere around 11.4%. So slightly different measures there, net income and earnings per share, depending on share issuance and otherwise. Okay, so nice little drop expected there for earnings, but that does kind of set up a nice low bar for you that might make it easier to beat. So let's look at B of A, and then we'll get to some data coming out at 5:35. So B of A data this morning. Looks like total deposits came in higher than expected, 1.88 versus 1.85. Trading revenue actually beat at Bank of America, 2.76 versus the 2.44. Non-interest expenses, 16 versus 15.78. Trading revenue beat over here, 14.38. This is a different version of trading revenue. They got two different trading revenues, FICC trading revenue and non-FICC. Okay. Provision for credit losses. Well, it'd be nice to know what the expectation was. 1.13. Let's see here. Earnings per share, 88 cents. loans of $1.05 trillion. That's what they were expecting. So stable loans, continuing to see a healthy economy, says the CEO. Bank of America looks like they're rising after this healthy economy, growing at a slower pace, resilient job market, 9.4 billion of compensation expense versus 9.5 expected. Imagine your payroll being $9.5 billion every 3 months. Wow. Okay, a lot of talk about the consumer still being strong from Bank of America. I think Bank of America is a good sort of slice of America. So this is good to hear. Bank charge-offs continue to normalize, some higher litigation expenses. Digital sales grew by 8%. What are you digitally selling? Anyway, headcount down to 213,000 through attrition rather than layoffs. So lost some folks here. Deposit balances still above pre-pandemic levels. My goodness, it's weird to think that we still have excess savings in this economy, but that's great. This is absolutely great. Shares did just dip negative, probably after that Morgan Stanley. So you went positive, then went negative. Bigger story is somewhat weaker net interest income than expected. One of the things here that you're getting with the banks is there was this big expectation that deposits would end up being pretty sleepy. What that means is that as interest rates rise, some of the banks expect people not to wake up and not move their money around. So they basically just, accept a 0% yield on their savings account while treasuries are yielding 4%. This is typically your sleepy deposit sector that makes these banks a lot of money. Unfortunately for the banks, but good for individuals, a lot of people have not been sleepy. People who are traditionally sleepy have actually come to quickly realize and adapt that no. We deserve a higher yield. And they're flipping on the banks and they're demanding either higher yields from their banks or they're going somewhere else with their money. That is what's supposed to happen. The free market would demand that you do that. Unfortunately, it is a pain in the butt to move where your assets are, to wire them around, to make new accounts. So historically, that's been considered a sort of a resisting force that has actually helped prop up some of bank earnings here. But now you're starting to see some of that unwind very quickly. I mean, it's almost daily that I hear advertisements when I'm listening to Bloomberg in the gym or wherever. And I hear these advertisements where people are, don't let the banks rip you off. Get a higher yield. You deserve it. Well, I mean, it's true and it's fair. But I think it's fascinating because you're now seeing that show up, some of these bank earnings. Fortunately, though, what we're really looking for out of the bank earnings is banking commentary. I want to look at some of JPM's commentary in a moment as well, just because we have their earnings call. So we'll look at some of the details on that shortly. But first, we've got retail sales coming out here. And this tends to be more of a market mover. So we're going to jump to retail sales in just a moment. Keep in mind that retail sales are going to be a tool for us to evaluate, okay, how's that recession looking? Are we still looking anti-recessionary, or are we trending maybe towards more of a recessionary environment? So we'll find all that out in just a moment. And then we'll circle right back to some of the banking earnings. So we'll call that the intro on banking earnings. Now we're going to go to retail sales. All right, here we go. Well, retail sales data is just 30 seconds away. If you haven't joined the Meet Kevin free newsletter yet, check out the link down below. It's right next to the link for the expiring coupon code. We still got about another 8 days left, though. Email us at staff@meetkevin.com if you've got questions on the amazing offerings on real estate stocks or otherwise. Right now, we've got retail sales data coming out. We are expecting a month-over-month advance of 0.5%, 0.5%. We're looking for X Auto month-over-month 0.3, X Auto and gas 0.3. Let's see what we get. And let's see, business activity in New York comes in flat as opposed to the prior read of negative 5.2. That's good. We'll take flat over negative and contractionary, but we're still waiting for that retail sales data number to drop. It usually comes out within the first 30 or so seconds after it's scheduled, and that is now. So any moment now, these retail sales numbers will pop up. Big deal because they'll guide us as to whether or not we're looking for a recession. Oh, actually come in a little weak. Looks like retail sales advance comes in at 0.2 versus the 0.5% expected. Waiting for some of the other core numbers here. But again, we got a 0.2. Okay, X Auto, we got 0.2 as well. X Auto and gas, we got 0.3. That's a match. So we got weaker on the headline advance. We got weaker X Auto and a match on X Auto and gas. So the retail sales report comes in a little softer than expected. It's still positive. A negative read here could have potentially shaken, whatever the grammar would be there, the Federal Reserve to potentially pause for July, which seems almost impossible right now. But what we actually got here is not a dramatic miss. We're not negative. We're still at positive retail sales. And these are month-over-month numbers, so it does mean that we're still contributing to GDP on a month-over-month basis. We'll look at the actual details of the full report in just a moment. Let's briefly listen to what CNBC has to say about it.
Down just a little bit. These numbers really are at expectations. The equity markets are moving a bit higher, and that's most likely because rates have moved down. And that has been the big move thus far. After the rejection a couple of weeks ago that closed above 507 in a 2-year at a day where it had an intraday high of 511, that failure really across the curve and the pause, when you add that in, has certainly made a difference in the market. All right.
Yeah, I'm going to pause there for a moment. It's not totally untrue as well that, what you see, it kind of cuts both ways. You get a weak retail sales report, and then what happens? Well, if it's a weak report, now all of a sudden we're worried about recession. If it's too strong of a report, now what happens? Well, now all of a sudden we're worried about the Fed having to potentially hike even more. So we got a slightly weaker than expected report, which potentially says, hey, Fed's good with one and done in terms of rate hikes here. We did get, or there was an expectation that if we got a big miss here, maybe it would lead the Federal Reserve to pause early. I don't think this is weak enough to suggest that the Fed needs to pause early. But let's take a look at this. The Census Bureau puts this together. Here are the retail sales, percent change in retail and food service sales from the previous month. You can take a look at some of these charts here. We've got total in the black, X Auto in the white bar, and auto actually popping off here in May. Look at that jump right there in autos in May. For some reason, that was a very, very hot period for autos. Makes you wonder what that's going to mean for some of the auto earnings coming up. Tesla, obviously, tomorrow. June on the right side, although we did already see delivery counts for Tesla, so it shouldn't be too much of a surprise. The question is just how much is margin affected. Advanced estimates of retail food and service sales for June 2023 adjusted, blah, blah, blah. We're up 0.2% from the previous month. Fantastic. Why? Let's get a little bit of detail here. See what else we can get inside the actual retail sales report. We're going to do so by looking at the percent change figure. We are looking for the June numbers. So the June percent change numbers are going to be right here. June 2023 advance. We're comparing May to June. Where did the numbers come from? Food, services, and drinking places. Is this correct? Is this actually a percentage? Hold on a second. 8.4. Hold on a second. That says advance. Okay, over here. Oh, yeah, these are all percent changes. My God. Okay. What happened? Food, services, and drinking places up 8.4%. Oh, we're looking at June 2022. Oh, my bad. Okay, yeah, that makes sense. Whew, I was going to say, that'd be quite remarkable to see 8.4% on a month-over-month read. So this right here on the left is actually how the retail sales report is always funky. It gets me every time. So here's how to read the retail sales report. Boy, it's a tricky one. So what we're going to do is you're actually going to look at this left column. We're going to put a big box around it. This is what you want to pay attention to. Those numbers are your change from May. So May to June, this is your month-over-month number. Here we go. This on this right side here, those are your year-over-year numbers. Okay, now we got it. Food, service, and drinking places, 0.1%. Non-store retailers, so this is like your e-com, your Etsy's, right? 1.9%. Miscellaneous store retailers, your downtown mom and pop shops, 2%. General merchandise stores, 0.1%. Department stores, negative 2.4%. Department stores, a negative 2.4%. Oh, interesting. You've got a sporting goods, hobby, musical instrument, bookstores down 1%. Clothing and clothing accessories up 0.6%. gasoline stores, so gas stations. It actually doesn't even say gasoline stores. My bad. Gas stations, negative 1.4%. Health and personal care store, that's going to be your Ultas of the world, negative 1.4. Food and beverage stores, negative 0.7. Building material and garden supplies, actually somewhat surprised by that, negative 1.2%. Also somewhat surprised here by furniture coming in up positive 1.4%. Yesterday I was looking a little bit at Lazy Boy, and the earnings were quite interesting, mostly because some of the things that we were looking at for retail sales were that Lazy Boy was saying they make a lot more money through their furniture galleries, basically convincing people and upselling them in person with staff. But that's more expensive, right? I did think it was very interesting, though, that they brag about wanting to have more sales than the industry average. But in my opinion, that kind of sounded like they were cheering about winning a foot race against people on oxygen tanks. Like you're kind of like cheering about winning in somewhat of an almost dying industry. You did have this suggestion that over the next 6 months, sales were probably not going to look that great, especially as they started advertising more, trying to make Lazy Boy seem like a little bit more of a modern company, less of a backlog. And so all of these numbers and data from Lazy Boy made me think we were going to see a negative read on furniture for the retail sales report today. We actually got a positive read on that retail sales number for May to June. So who knows? Maybe it's just Lazy Boy as they start talking about and taking more discounting rather than positive pricing action. Anyway. Wow, electronic and appliance stores. That's also somewhat of another surprise, 1.1% to the upside. Basically, I mean, compared to last year, it's basically flat. I mean, you're barely up here. It does beat the decline in the 4.6% furniture, 3.2% building materials year over year numbers. Health and beauty, it's where you've seen some of the strength year over the year, 6.3% positive. Motor vehicle and parts dealers, 0.3 for the month over month. And then we've got the total retail number coming in at that 0.2. Again, a little weaker than expected, but still positive. Not only still positive, but not weak enough to get us any kind of suggestion that the Fed would not follow through with their 25 bips this month, which is not that big of a deal. Give us the 25 bips. It's fine. What's another 25 when you've already hit us for 500? A lot of people get mad when I say that, as if they think I can somehow manipulate Jay Powell to not give us another 25. But really, you didn't get to 25. Not that big of a deal. Suck it up. And yeah, we'll probably end up with a little bit of a higher for longer Fed. But overall, we're on the right trajectory. Now, pre-market is slightly red. I don't know if that's going to be indicative at all for what happens during the day. Generally, it's not. Yesterday, for example, almost every index was red. The NASDAQ went slightly positive by the time of the opening bell when we do our course member live streams and fundamental analysis together. And everything just ended up basically, well, I mean, we had pretty large tech rally towards the end of the day yesterday. I mean, Enphase was killing it. Some of the other tech stocks were killing it as well. Right now, you've got Dow, S&P, and NASDAQ all down single basis points. Big deal. You've got the 10-year Treasury falling again to 3.76. Not strong enough for you to really get a push over here. You've got the dollar relative to the euro roughly flat, falling a little bit relative to the Japanese yen, rising a little bit to the pound. So there's some typical volatility here. BTC back under 30K. Gold still stuck in 1968. Can't seem to get it up over 2K. Brent back under $80 to 78.74. So overall, I personally would look at this and go, retail sales, okay, wasn't bad news. Nothing to phone home about. Let me see if there's any kind of commentary from the good old suits here on this retail sales number. So no, it's too benign to really go crazy commenting about. Oh, now this is interesting though. You did have the revision for the prior month was actually moved up. So now it's really just a stable report. Goodness gracious. So what looked like was a slight miss here of expectation of 0.5 going down to 0.2 also now includes a prior revision of a prior read of 0.3 being revised up to 0.5. So today came in a little softer, but the prior was revised higher. The prior was revised higher at every category. 0.2% on retail advance, 0.2% up on X Auto, 0.1% up on X Auto Gas, and up 0.1% on Retail Control Group. Control Group also beat this time, coming in at 0.6 versus 0.3. So nothing here screaming recession, which is fantastic. Absolutely great news. So we'll keep an eye, obviously, on this sort of data. If you like it, keep subscribing and sharing the videos. Okay, good. Let's hit the next one. Canadian month-over-month core CPI came in at -0.1. Headline came in under 3 at 2.8. That's fantastic. Maybe you'd finally see them hit their peak there. Interesting car for coin. Gary Gensler's long speech on the dangers and scams around AI. It's unfortunate. I mean, there's every time there's something new, it's scams. It sucks. It's why I always say, look, I'm here every day. Well, I try to be here every day. But I got the cup. I'm not effing leaving, no matter how hard it gets. I haven't stopped making videos since I started in 2017. I don't intend to. So anyway, retail sales complete. Next up, we're going to talk about the This Time Is Different. This is a great piece. By the way, we do have Twitter Spaces rolling as well. If you'd like to chat in Twitter Spaces, send me a request to chat. Don't be shy. Don't be bashful. If you have something to say, come say it. And I got the mute button, so if you're a hater, we'll just... All right, what do we got? Oh, yes. All right, Goldman Sachs report. The This Time Is Different report. These are my favorite. All right. Are you ready for This Time Is Different report? Let's get into why Goldman Sachs says this time is different and that the inverted yield curve isn't as bad as it seems. We know that generally the inverted yield curve, when you look at the difference between the 10-year and the 2-year treasury being inverted, is a surefire signal of a recession to come. And it is one of the most prominent signals for bears to say, we're done, we're out, we are sitting the sidelines because it's just a matter of time. The bond market knows best. Now, Goldman Sachs says, well, maybe they don't. Let's analyze why Goldman Sachs thinks that, especially since the most dangerous words in investing are this time is different. But before we do, let's give you a quick reminder of what the yield curve chart looks like. This is the chart of the inverted yield curve. As you can see, we had a massive inversion lower than where we sit now right before the banking crisis. We were so inverted because that February and January data was coming out so strong. Markets were convinced the Federal Reserve was going to hike us to oblivion. When the banking crisis occurred, we actually had a very rapid steepening of the yield curve because markets thought, oh my gosh, this is it. The Fed will stop hiking because of the banking crisis, and they won't drive us into a deep, dark, ugly recession. Now, the bond market once again seems convinced, with an almost 100 basis point inversion of the yield curve. This type of inversion, by the way, forecasts over 500 basis points of Fed cuts being priced into the market going forward. Now, there is a potentially simple explanation, then we'll look at what Goldman says. The potentially simple explanation is, look, everybody expects inflation to be transitory now. And if you expect inflation to be transitory, you expect that the 10-year treasury yield and the 2-year treasury yield won't last this long. So what happens? People demand a higher yield now for 2-year bonds because we're still in a period of high inflation. But when that high inflation goes away, people will once again return to accepting a lower yield on the 2-year and a higher yield on the longer-term commitment, the 10-year. Who knows? That's been my simple explanation, though I give a lot of credence to the bond market and I like to pay attention to anything that's potentially a negative signal. I'm not a big fan of getting trapped in confirmation bias. I want to see what is everyone else thinking. But lately, all the bears have been flip-flop. Okay, well, not all of them, but I vomit when I see the bears flip-flop with the argument of, well, we're still bearish, but we're going to increase our equity allocation because, stocks are going up. That was T.S. Lombard for you. Last a little respect there. Anyway, Goldman Sachs. First, I think note 4 is their inverted yield curve discussion. But let's take a look at some of the things that Goldman Sachs is saying here. First, Goldman Sachs just cut their probability of a U.S. recession starting within the next 12 months to just 20%. 20%, that is down from 25%. It is also down from the 35% chance of a recession within the next 12 months that they argued for back during the banking crisis. And it is way below the 54% amongst Wall Street Journal economists who are surveyed on the probability of a recession within the next 12 months. Now, what do we have on the second argument here? Argument number 2, U.S. economic activity remains resilient. Q2 GDP growth tracking at 2.3%, consumer sentiment rebounding sharply from depressed levels, unemployment falling back to 3.56% in June, initial jobless claims reversing most of their mini spike in jobless claims. True, those have been pretty stable. We do expect some deceleration in the next quarters when it comes to employment because of the slower real disposable income potentially leading to some lower sales. Interesting, especially since we did just get retail sales numbers. Prior report, May report revised up a little. June report revised down a little bit. But easing financial conditions, think about that. A rebound in the housing market, easing financial conditions would be lower yields. We have been seeing that. Rebound in housing, I have been seeing that. And the ongoing boom in factory building all suggest the U.S. will continue to grow, albeit at a lower trend pace. Okay, it's a good setup so far. Then they argue that even though we have this student loan headwind ahead of us, which is now widely being associated with basically a 5% cut in people's income, Goldman Sachs believes the biggest growth drags are really behind us. I've personally been arguing that we really lack a lot of negative catalysts ahead of us. Short of some kind of black swan, it's very difficult to see big negative catalysts right now, unless we have some really bad earnings season. But so far, that doesn't seem to be the case. The 0.16% increase in CPI ex food and energy in June was the lowest since Feb of 2021, follows a string of 0.4 readings. But it doesn't mean it's just 1 month of better news, as measures of underlying inflation, such as trimmed mean CPI and PCI, or PCE rather. Here I am thinking about PCI cards for computers because I'm installing one. But anyway, PCE has been easing for quite a while. Moreover, there are strong fundamental reasons to expect ongoing disinflation. Used car prices are sliding on the back of higher auto production and inventories. Rent inflation still has a long way to fall before it catches up to the message from median asking rents. So that's owner's equivalent rents, which is what CPI uses. It's like a 34% weight. And market reads of rents. Big disparity still, suggesting you still have a lot of tailwind to get this inflation down, which is great. And the labor market continues to rebalance with a slow downtrend in job openings, but then also fewer quits, which is good, and nominal wage growth. That's still positive for workers because you're still making money. Real wage growth just went positive, but it is you're not growing your wages as quickly as you once were. Now, what about the yield curve? Because this is the part that I think is so fascinating, where you have Goldman Sachs finally, and it's been a while. I mean, I've been trying to explain why it's possible that the yield curve could be inverted and not signal a recession for, I feel like, a year now. Anyway, Goldman Sachs, here we go. We don't share the widespread concern about yield curve inversion. Conceptually, an inverted yield curve means that the rates market is pricing in future cuts that are large enough to outweigh term premium, which accounts for its usual upward slope. In English, when the yield curve is inverted, markets expect the Federal Reserve to cut rates so quickly and in such a large way that you have higher yields now that are greater than the usual reward you get for committing your money longer. Usually you commit your money longer, you make more money. And when you get an inversion, it's because the markets, for some reason, are expecting big cuts. Now, there are two reasons the markets can expect big cuts. One, recession panic, and then you get, cuts and a steepening yield curve, and that tends to be the really painful part. It's not the inversion, it's usually the steepening that's the painful part, usually. And then, of course, you have this potential for disinflation to be why we're seeing this. But okay, let's keep going with what Goldman's argument is. Okay, so reading this properly, in the past, this has generally, in other words, the inverted yield curve, right? Are you ready for this? This has generally only happened in situations where a recession was becoming clearly visible. Okay, now this is important because they're arguing that usually you saw a yield curve inversion once it was blatantly obvious that you were going into a recession. Now that's interesting. We'll look at some charts in a moment here, but that's very, very interesting. Hence, the curve's strong track record as a recession predictor. In other words, they're kind of throwing cold water on this indicator saying, look, it's so good because by the time a recession is usually obvious, that's when the yield curve tends to be inverted, when it's already obvious. That a little bit feels like cheating, honestly. But okay, let's keep going here. So, but three things are different about the current cycle. Oof, boy, we love those words. This time is different. Not really, but okay, keep going here. Three things are different. Let's hear what the three things are. First, the term premium is well below its long-term average. Okay, in other words, the amount of money that you get compensated today for investing your money into treasury bonds longer is already relatively low. So you don't get that much of a premium anymore these days just for investing your money longer term. Before COVID, the premium you'd get between the 10 and the 2 year, like if you looked at 2018, was somewhere around 30 to 50 basis points. Relatively low. That was your positive term premium. Okay. Second, there is a plausible path to Fed easing on the back of lower inflation. Now, of course, some bears argue this is going to lead to a disaster of basically the Fed creating, stimulating again, and then what? You end up with an oopsie doopsies inflation again. Now, remember though, we already know because we've studied this so much on this channel that what caused inflation during COVID was not the fact that we printed money. It was how rapidly we printed the money. So yes, we could return to what we saw between 2010 and 2020, which is where we slowly printed money and didn't have any inflation. Kind of wild. All right. In fact, both our and the next FOMC's non-recession projections call for more than 200 bips of gradual cuts over the next 2 to 3 years. That's 2 to 3% of cuts over the next 2 to 3 years. Third, okay, so two reasons so far. We started out with a low term premium. We're already pricing in Fed rate cuts without a recession. So, usually you get an inverted yield curve when you're pricing in rate cuts because of a recession, but we're not seeing a recession yet. So the inverted yield curve happened so early. And maybe that's a sign that, the markets are just reacting to the fact that the Fed's expecting to cut. Okay. Third reason, if forecasters are overly pessimistic now, rate market investors, and thus expectations priced into the yield curve, are probably also overly pessimistic. So the argument that the inverted yield curve validates the consensus forecast of a recession is circular. In other words, the more people say the inverted yield curve is going to cause a recession, the more people in the bond market start pricing in a recession. And then the more economists start pricing in, oh my gosh, we're probably going to have a recession in the next 12 months. And then you get this sort of reiteration. Now the yield curve inverts even more, blah, 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 blah. Right? Now, there are two more pieces here from Goldman Sachs, but Matt Thompson here says declining earnings in commercial real estate are big negative catalysts. The problem with this is, as we just saw from the Wall Street Journal, S&P earnings are already expected to fall 8.1% per share. EPS down 8.1% per share year over year. You're in the earnings recession. Yeah, what's the stock market doing? It's going up. Why? Why is it going up? because people didn't believe inflation would be transitory. Now that it's turning out to be somewhat transitory, people are slowly getting back in the market. In fact, a lot of us, I guarantee it, and some of you watching this feel this way right now, a lot of us are like, please just give me one more dip. I've been missing out. Let me put more into the market. This is normal. It's totally normal. And when we look back at 2020, everybody was like, please let there be a double dip. I just want another chance to buy, bro. And it just kept going up and up and up. I'm not saying it's healthy, how quickly it's happening, but it's remarkable that the market is going up when you're already expecting negative EPS of 8.1% and net income falling by 11.4%. Now, this other argument Matt Thompson here says is that, well, what about commercial real estate? Well, so far, commercial real estate has done jack huda nothing. Sure, there are write-downs for offices. Loan loss reserves are going up, even at banks like Morgan Stanley for these offices, and potentially this office and retail commercial crush. But I mean, we're talking about 3-4 years before we start seeing some of these refinances really roll. And at that point, is the economy already well beyond? Who knows? Now, Zero Phases here says, but the S&P 500 is overbought on the 6-month chart. Been overbought for like 3 years. It makes you wonder if it has to do with sort of how rapidly people now get in and out of the stock market. Who knows? Okay, so let's get to the next argument from Goldman here. Argument number 5. Check out Meet Kevin's amazing programs on building your wealth link down below. Not only is there a free newsletter you can click on down below, but you've got these incredible courses. We do fundamental analysis on real estate. We do those in our live streams as well. We're going to be doing a lot of those in together when we're doing analysis for House Hack or your own deals. Property management, do-it-yourself property management, rental renovation, stocks and psychology of money. And probably the most popular bundle right now is the triple. Stocks and Psych, Zero to Millionaire Real Estate, and this, how to get more done, and how to make more money and get SH9T done faster, featuring AI. It's basically where I break down exactly for you how you can actually be productive with artificial intelligence today, rather than like trying to learn how to sit here and code or whatever and figure out how you're going to create your AI bot or whatever. Let's get you caught up to speed and get you productive with AI today. That's what this course does, along with, some of the other amazing things. So check that out, link down below. Email us at staff@meetkevin.com if you got bundle up questions. So going back to Goldman Sachs right here, a 25 basis point hike, 5.25% to 5.5% at the July meeting is almost certain, but we expect it to be the last of this cycle. Despite some assertions to the contrary from more hawkish participants, we don't think that the September meeting is truly live. Both in the June press conference and in his congressional testimony, Powell argued moving carefully, or at a careful pace now, since we're closer to our destination. The minutes also signaled they probably didn't have a majority for confirming what they're going to do at the next meeting. But what's more likely to be live, according to Goldman Sachs, is the November 1st meeting, where you're going to end up with 3 more CPI reports and 4 more PCE reports. Lots and lots of data. All right, then we've got number 6. Most of the G10 banks are still a little bit further from the Fed at completing their tightening cycles. Now, we did just get some great numbers from the Bank of Canada for inflation. Thanks, Max, for pointing those out on the month-over-month decline there at headline under 3%. The Bank of Canada is still widely expected to deliver their final rate to 5.25%. They're probably just trying to copy America. We expect the Reserve Bank of Australia to deliver one more 25 BP hike. Let's see, and another 2, in August, and then another 2 later in the year. No big implications for some changes of the guard. You've got UK is probably going to get to a terminal rate of 6%. Another 100 basis points to go, thanks to that rising core inflation rather than falling. And then Goldman Sachs does price in fewer cuts for Canada, Europe, and the US than markets are looking at for next year, which is somewhat negative, right? But that's also on the back of a stronger economy. So when we look at the inverted yield curve chart-wise again, This is the inverted yield curve over history. And what I'd like to see is, when did we actually get this inversion here and here in the dot-com era? Let's compare that. So I'm going to get the actual dates for that. So the inversion in the yield curve happened first, and it looks like it's going to be in 07. 06. 06 was your first inversion. I don't know if you could say that we were convinced that a recession was ahead of us by 07, but okay, interesting argument. Still Goldman Sachs. Then you've got the 2000s era. We really saw the inverted yield curve as early as February of 2000. I mean, these were pretty leading inversions. So I think that the leadingness of some of these inversions actually potentially gives you a little bit of a counter argument to Goldman here, in that we had are below 0% here pretty early when you had the recessions, certainly later. The recessions almost more where the steepening sat. So I don't know if that really helps Goldman's argument much. But either way, I personally do agree with a couple of the arguments they make regarding the inverted yield curve, that you've got this doom loop of forecasters go, oh, no, definitely recession. That increases your inverted yield curve. But you also have my argument of disinflation, and then Goldman's argument of Fed rate cuts already being priced in a non-recessionary environment. So is it possible this time could be different? Who knows? Again, those are the most dangerous words in investing. So you should prepare for no. But then on the other hand, do you prepare for yes? I don't know. I don't think this is where you could just look at these data points. You have to look at everything holistically. Stronger retail sales, or at least non-negative retail sales, consumer spending, Bank of America suggesting, hey, people still have higher deposits than they did before the pandemic. Inflation trending down very rapidly. Earnings not coming in as bad as expected so far. Fingers crossed it stays like that. But we'll see. All right. Somebody says the connection on Spaces is crackling a bit. Well, that's not great, especially since I wanted to get some speakers in here. What I can do is get a little replug going here. Hold on a sec. Oh, I hate the plugs, man. All right. I don't know if that's going to be any better, but let's go ahead and bring somebody in here. Let's bring, who's this? Esteban? All right. What do you got to say for yourself? Welcome aboard. So, all right. I'm going to get Toro in here as well. If you want to speak in Twitter, go ahead and request on in. Make a note of
Hi.
Hi there.
So I ended up writing this as a comment because of the fact that I tend to ramble. So I'm going to ask my question, as well as, do you know what the nest is in Twitter Spaces?
No, I don't know what that is.
Okay, so you should probably know this. Every space that is held, somebody can post an image or a chart to the top of the space so everybody can see it and what you're talking about. So you just want to be careful if you end up having anybody come up here, because they might post things you don't want. But anyway, so can you please explain how hiring since the pandemic is not a bubble, as well as why the yield curve does not reflect the Fed stepping on the economy brake? For my opinion, reducing the spread in interest rates reduces lending and reduces the, obviously, economic growth in the economy. This is not a uniform, predictable, replicatable process, in my opinion, because humans are involved and there's this psychology of what's going on. And this is why the Fed, in my opinion, always misses. And I'm just curious as to why this time will be different. And I have some charts that I've been looking at, and I shared it in the nest if you want to take a look.
Yeah, thank you for that. So I want to clarify. So I got hiring since the pandemic. In other words, how is that not a bubble? I got that. What did you say about the yield curve? I just missed that part.
Okay, so when I talk about let's say hiring since the pandemic, so I look at year over year growth or change in total non-farm payrolls, as well as the economy. And every single time since World War II, our economy year over year has been growing at a faster pace than non-farm payrolls, except for since the pandemic, which I find interesting. it essentially means each additional person being hired is providing less and less economic output in our economy, which is less efficient. So I have a feeling at some point businesses are going to realize this and say we have enough people. Previously, how much we were producing per person was higher. We're going to try and get back to there. And you're going to see a reduction, in my opinion, in hiring, as well as, since interest rates are higher, there's less liquidity. So they're going to be looking to cut costs. And I don't know why. I'm assuming the reason why there was so much hiring is because they were, preparing for some kind of large economic boom because of all the cash and spending that was going on after the pandemic. But it's just, it seems like overdone it. As well as when it comes to the yield curve, I looked at the last 10 times, and on long-term trends is a great website, but the last 10 times since, World War II, the yield curve has compressed, meaning the 2-year has started to get to the, parity or higher than the 10-year. Essentially, that's really cramping banks because they don't have a spread that they're making money off of as much. So they're reducing lending because they're not going to take as much risk with a lower reward, and then they reduce lending into the economy. That's reducing the increase of money supply, that reduces spending and slows the economy. So I look at the yield curve more as like this mechanism the Fed uses, like a brake in a car, and they're braking on it to slow the economy down to lower inflation. But the thing is, money doesn't move through the economy uniformly each time during each recession, and people also each time have, a different psychological view or opinion, because we in 2009, we went through this experience with, money and what went on. We're not going to make that mistake again, but every time is different because people have different experiences and different mindset and different view. So I think that's why they always miss, because they're trying to do something for the last time and they're not seeing what's happening this time.
Got it. Very well. Let me quickly replug the mics here, and then let's talk about that. 1 second here, just so you can see. I know there's a little bit of crackling. I apologize for that. 1 second. Let's see if we can just do this. I'll tell you, for those of you on YouTube, this getting your audio through here without some kind of desktop studio is just the stupidest thing ever that Twitter can do, because it's just terrible. Okay. All right, there we go. I'm not sure if that's better, but we'll go with it anyway. Okay, so let's start with. No, it's not. I still hear the crackling. So hiring. Well, I'll go ahead and mute on this side the receiving audio for Twitter, so at least it kills that. Okay, so hiring since the pandemic being a bubble, I don't disagree with that. I think during the pandemic, everybody's business was growing so quickly, and there was such a lack of labor because a lot of people didn't have to work, that whatever labor you could get your hands on, you wanted to keep. And I think there were a lot of businesses that really thought business was just going to go on forever, like it was in 2021. That could be seen in even, for example, your freight industry, where let's just buy more ships, let's buy more, semi trucks, let's get more containers. And now all of a sudden, oh my gosh, now we're at negative growth and you're really in contraction in freight. I think freight is a great place to look. And so, yeah, absolutely. You're going to see this constant rebalancing. I think the pandemic really screwed up a lot of things where you had massive hiring boom, and that has turned into labor hoarding. And you'll see less of that labor hoarding, and those people are going to have to go somewhere. Now, whether that means they go into retail and hospitality and lodging, which is done very well, and they get absorbed there, or they end up having to essentially adopt new skill sets and get into maybe new areas of the economy. And the new area of the economy that's booming right now might be your artificial intelligence direction, which initially seems like, wait a minute, that's potentially bad though for hiring, right? Wouldn't people get displaced from AI? But what if companies are so clueless about AI, there's actually more hiring at first, because they've got to hire people to help them figure out how to integrate artificial intelligence. So the economy is definitely going to go through what I call this rejiggering. I don't know that it's so clear, though, to say that just because there's going to be rejiggering, we're definitely going to have some form of massive crisis on our hands. But I do agree with you that there'll probably be less hiring, but not just reduced hiring, which we're seeing with reduced job openings, but you'll see layoffs, and people go to the other jobs that have opened up or are still open, and will become more to a balanced environment. It's sort of like what Jerome Powell suggests. A balanced market or labor market would leave us with about one job opening per unemployed person. We're still somewhere at 1.5. So we're still elevated with how many openings we have. So for us to really see that sort of crush and reduced hiring and more layoffs, we'd really expect that number to decline a lot more rapidly. We're just not seeing that yet. Now, regarding reduced lending and reduced money supply, and the yield curve sort of break on the economy. I mean, I think that's exactly right. That's the goal of the Federal Reserve. Hey, let's slow down how much money is circulating so we don't overheat and end up in a 1980s disaster where we need to raise interest rates to 20% to just control and rein in this economy. The interesting thing is that I think is frequently missed is that we can have flat growth and still be at a phenomenally strong economy, because we really went from so far above trend in 2021 that anything that's even remotely flat growth is still so much higher than what we saw in 2019. I always like to draw out this sort of line that just goes, you're trending up from left to right, and then all of a sudden you explode up, and then you get a flattening. You're still way better off now than where you were before, and I feel like many businesses feel that way, and that could potentially give staying power to this stickiness of labor hoarding. That I think is very interesting. I'll go ahead and unmute Twitter here again if you want to add a little bit more thoughts, or if you have other questions. Maybe I may not have addressed all of yours, but feel free to chime back in here.
No, I don't have any other questions other than when you get a chance, take a look at the charts I've shared, because it's very interesting to have this pattern repeating where our economy is growing faster than labor growth, and that makes sense. But then all of a sudden we've had this change. I think we're going to experience a lot of changes this decade, as in addition to I think our monetary system has changed because of the pandemic. I don't know if this trend is going to continue or if it's going to go back to what it was. Personally, I think it'll go back to what it was previously, and we may have a different recession than we previously have experienced as well, in which case we see the hiring slow, but it's not as though they're laying people off and they're just finding ways to use these people more efficiently. But then hiring has typically been a large contributor to growth, because in my opinion, until they stop hiring, the economy is going to keep growing, because every month you add 200,000 more people. That's whatever the average income is of those jobs over the next 12 months. That's a huge amount. And most people are going to spend the checks that they earn. So that's a huge contributor to our growing economy. So I personally believe so long as they keep hiring, we'll keep growing. But once they stop, that tends to be the problem. We're going to try and use our people more efficiently. You'll see a reduction in hiring, and we'll probably be closer to the end of this. I still think the economy can grow despite rates having risen, but I also don't think the yield curve is wrong. And we're
Hey, can you hear me right now?
Here.
Hey, we can hear you. Hold on, if you wouldn't mind, let him finish his thought here on the yield curve.
Yeah, I just feel like we're getting closer to, and probably within a year of growth turning negative. Now, I agree with you. I don't think that is bad for everybody, but overall, I do think we have to be close to the tail end of this, in my opinion. But anyway, Turo, go ahead.
Yeah, and quickly, I want to just jump into that chart that you're talking about. Let me do one more thing, though. Before I do that, I'm just going to quickly switch phones and see if that does anything for the little crackling here. 1 second here. All right. We'll see if that's any better on the other phone. But this chart that you're referring
You're
to.
echoing. You're echoing on this one.
Thanks. Sorry. There we go. Good call. Okay. Oh, Twitter Spaces. I still hear the crackling. Twitter Spaces has been the biggest headache for me to try to get functioning well. And I feel like I'm technically savvy enough to handle it, but apparently I'm not. So, okay. Take a look at this. This is the chart that you've been referring to. I have that up on YouTube and the Twitter live stream video. And what you're saying is the red line is generally below the blue line. So blue line is your gross domestic product. And these are percentage changes. And if we go back to 1970 here, just to zoom in a little bit, we can see the blue line is always above. And it somewhat, well, not always. In some of the recessions over here, you get these brief flips. But generally, the blue line is well above, even in recessions. Even in 08 over here, it seems like most of the time the blue line is above, early 90s. And so what's probably happening here is when we have these bizarre year-over-year percent changes, the environment we're in now is that we have this positive percent change for employment, probably to some extent because of base effects comparing to last year. We can see that if we look at the nominal numbers. And then, of course, GDP is slowing because that's the purpose of what the Fed's trying to accomplish here. Let's go ahead and remove line 1 for a moment, and let's see if we could see some of the base effects of employment and see if there's like a hole in employment last year. And what we're looking for is the nominal thousands number of employed. And let's try to understand this. So no necessary hole, but if we look here at 156, compare that to June of, where's June of last year? June of last year is right here. You have this growth that's exceeding GDP, probably because you're below trend from 2019, right? So and we get this a lot with charting, is when we look at charts that are percent year-over-year changes, they could look very, very scary. Let me show you that slightly differently. So we're just going to Google St. Louis Fed money supply. Okay, watch this. So we're going to pull the money supply. We're going to edit this graph, and we're going to do the percent change from a year ago graph, right? And look how scary this chart looks. The chart looks miserable because it's a percent change chart, and it looks very, very negative. But when we change this to a nominal figure, what do you get? Well, you get a trend reversion. You get, well, of course, trend was here, and we're finally reverting to trend. So, of course, on a year-over-year percentage, we're going to have this massive negative for the rate of money supply growth, which, again, is negative. Go back to the chart that you've referred to, all employees chart. Look at where the trend line is. On trend, we should be significantly higher with employment than where we are now. So is it possible that one of the reasons the chart looks so different that you've provided now is because we're still way below trend? Absolutely. And so I would caution when we look at those year-over-year numbers to consider, okay, yeah, we also had this crazy pandemic that skewed all of our numbers in such a dramatic way that, you know, when in our, you know, recent history have we seen everybody stay home and everybody who works at a place where you have to go to work is basically fired or not working, right? And it takes a while for that to all come back. So that's just, you know, obviously one example. Feel free to chime in again. I've got Mike unmuted here.
No, that was, thank you very much for your insights on that. I'm going to look into that. I like hearing different opinions. So I'll leave it at that, but thank you very much for reviewing that.
Yeah, absolutely. Thank you so much for your insights. Really appreciate it. Okay, let's see. I think we had Toro. You had a request here. Go ahead and jump in there, Mr. Toro. Thank you so much, Esteban. That was a very great insight. All right, what you got, Toro? I've added you as a speaker. What's up, Carl for Coin? I'll add you in here as well, but we'll wait for Toro first. Go ahead, Toro.
Yeah, this is a really quick question. First of all, thank you, Kevin, for being so nice in the Tesla event. I took a picture with you and just ran away. I was super nervous, but thank you for that. So
Thank
my
you.
question is regarding Bitcoin and crypto. I've been following you for a while, but I don't know if you have say recently what percentage of your personal portfolio is allocated to crypto, and if you are waiting for some dip to load more. Are you bullish in these regulations? And if you have any insights that you want to share on where do you see the market going now that we get closer to this approval?
Yeah, absolutely. So I think there's definitely a big opportunity for trading in crypto, and I personally can't wait for there to be Bitcoin ETFs or crypto ETFs, and I'll tell you why. I have this a long run goal for the vast majority of my portfolio to never pay taxes on stocks. And that pisses a lot of people off, but it's very simple example. So here's how you can do it. The way you can never pay taxes is essentially you take the money that you earn, you pay the taxes that you earn, or the taxes that you owe from the money that you earn, and then you throw them into some form of like an ETF. And if you never sell that ETF and that ETF rebalances with the appropriate tax strategies, you may never have to pay taxes, and you get rid of companies that are going BK over time or are failing. You could get this with passive ETFs, whether it's the SPY or the NASDAQ or otherwise. They're great opportunities for that. So for a longer run set of a portfolio, I think a great balance of ETFs and real estate, where you could also take advantage of never paying taxes, is a great way to build up a long-term portfolio. I actually think that's really bullish for crypto in long term when we start getting those crypto ETFs, because you do create those sort of shelters. Now you can do this also in a way of just holding Bitcoin individually, for example, or Ethereum individually. And this is where my second problem comes with having a longer or a larger allocation, is I've been so enamored with how low some valuations have gone for stocks. I haven't been compelled yet to get away from my fundamental analysis. Like, I'm still every day jumping up and down, for example, about my enthusiasm for $26 of tax credits going to every microinverter that Enphase sells, and the stock market ripping Enphase off right now, which is a great opportunity for me to load the boat on Enphase. And I keep adding to my Enphase exposure because I think it's awesome. So it's twofold. One, it's the ability to reallocate with an ETF and the tax benefits there. Two, real estate. So I guess it's threefold. Three would be that sort of fundy analysis. But yeah, like I said, I think there are definitely trading opportunities. But in terms of a larger fundamental position right now, it's less attractive to me just because of where I feel like I have a little bit more of a competitive advantage via fundamental analysis, or of course real estate. Car for Coin, you'd probably like to jump in on this. Where am I wrong? I know you sold your car to buy Bitcoin at 19. It's at 29K now. You're doing great. So you had a great discussion with us last time. Go ahead and unmute and let's see what you got.
Hey, Kevin, can you hear me?
Welcome back. I can hear you just fine.
I have a good microphone on, and I really appreciate this. First of all, I think you're amazing.
Yeah.
And what the previous guy said, Toro, I just want to tell you, you don't need Kevin's approval to buy Bitcoin. It's okay. You have my permission.
That's true.
Everybody has different strategies. And if you're looking, like Kevin's waiting for an ETF, and one of the biggest risks of crypto is theft. Or an exchange going down. So for the tax benefits in my SEP IRA account, what I've done is I've loaded up on Coin, Riot, and MicroStrategy. So Coin, for the obvious reasons, is that it's been beaten down by 90%. Riot, because that and Marathon are both we're also down by 95%, and their Bitcoin mining seems to be sustainable. And MicroStrategy, since they're one of the biggest institutional holders of Bitcoin with 150,000 Bitcoin, and it seems to be pretty correlated to the price. So that strategy has worked well. It does give you the tax benefits. That's my personal strategy. It's not, my advice to you. And like Kevin said, you can also hold it directly. So, Kevin, I do think I think it is a bit of a confirmation that we live in a simulation, that I've been waiting for 3 years for this Ripple lawsuit to end, and then the same day, after trying to get on your call for 7 months, it happens within 2 hours of each other. I think that was pretty funny.
Yeah.
And Coinbase, of course, popped by 25% when that happened.
It was remarkable. It was wild to think that we had that crypto discussion about how 2024 could be such a unique opportunity for crypto, because hopefully we'll have regulation in place by then, but also that we have the halving coming up. That at the same time as that, essentially, you get this Ripple ruling, and then you get the slap of the SEC and the Coinbase v SEC, judicial commentary. There's some great things, really positive catalysts that all came out really at the same time there. It actually surprises me that BTC hasn't moved more on some of that positivism. Why do you think that is?
It's a great question. In crypto, everything takes turns on how things move. Bitcoin usually moves first, then altcoins move, and then other things move. So when there's bullish news on altcoins, specifically regulation, money tends to flow into altcoins more. So even XLM, which is a random dead chain, I'm going to upset some people. Even that one pumped by like 70% when Ripple did. I do want to say your review of the Coinbase versus the SEC transcript was very interesting and very good. That was a great video. You could have done a little bit better job on the XRP transcript because some things you've missed were that.
Oh, on the Ripple, I agree with you on Ripple.
Yeah, which is okay.
I went back to it, and I when my first glance read, I don't think was good about it. I agree with you. I didn't end up posting a separate video about it because I didn't like it. We went through it again later in the day with my entire team. And we're like, you know what? This is really a judge coming in and saying, look, SEC, you don't have jurisdiction here. If anything, this is more like a commodity, and y'all ain't the commodity folks, so F off. It was a lot better on second read.
Yeah, the one thing that was very interesting is one of the Howey test things, prongs, is you're relying on a central authority, you're relying on the efforts of a central authority for the price to go up, right? On those efforts.
Right.
So
profits from the efforts of others, right?
Right. So I, in the chat, in the comments, actually put a good summary of the settlement. And essentially they said that transactions through Coinbase are not securities, but Ripple is not allowed to sell to institutions directly. So when you're selling to an institution in America, they do consider that security. But if you're an XRP holder, that just means institutions have to buy on the spot market, which is great for long-term price action. And the other thing is, with a price relying on the efforts of Ripple, there's a much stronger correlation of the XRP price moving in correlation to the altcoin market. We call it the altcoin season after Bitcoin has stopped before the lawsuit versus their specific efforts. So it is true, a lot of times in crypto, when you read some news, the price will go up, like Hedera, HBAR. They're testing some banks right now as a CBDC pilot program, and that price went up by 5% today. So that will, there's some correlation, but overall, altcoins within similar market cap will move together after Bitcoin.
Yeah, that's really interesting. Yeah, I do think regarding Ripple, and we've got maybe about a minute left before we get to jump to the course live. But on Ripple, one of the things the judge commented on was that Ripple never advertised or suggested that people could make a profit from the efforts of the folks over at Ripple. This is obviously exactly the opposite of what you hear in the stock market, where you literally have a board and executives saying, no, we are trying to make you money, invest in us because we're trying to make you money. That, I think, was actually a very good distinction as well to help separate a security from something like, Ripple XRP and potentially even other coins and tokens.
Kevin, I am a paid course member, so this counts as a live stream. So if you give me 30 more seconds. So
go ahead.
This is really bullish for Coinbase because that transcript you read, which was already really bullish, was before this XRP thing. So right now, the SEC is claiming that Cardano, Solana, and all these altcoins are unregistered securities. But Ripple, which is one of the most centralized ones, now that it's not security, the Coinbase is getting his butt kicked. That's how I feel.
Right.
So.
Right. Very good point.
Before you guys, can I just say something really fast?
Let me get the bell really quick, folks. Here we go. We got the bell coming in, and then we'll get you in one sec.
Plaintiff's attorney, you now know where to go to see groundwater poisoning, and that's what they'll do. They will advertise, and they will suggest if you had, or any of your children had any sort of brain injuries or breast cancer or an instance of cancer, then we would welcome.
There you go. Welcome to the opening bell. Markets open. Nasdaq dropping a little bit. All right, we got to go shortly. Go ahead and add another thing there, Toro, and then we'll wrap this up.
Yeah, just really fast. I was just thinking, do you think that this global acceptance of Bitcoin is going to put some pressure on China to finally, I don't know, make some advancement on the adoption of Bitcoin, and then finally the U.S. will be forced, if China is doing it, well, we don't want to fall behind, and eventually that's going to be a drop that lead to some more adoptions here in the U.S., or that's completely nonsense?
Probably quite long term would be my take. I don't know. Quick reaction, car for coin.
Yes, Bitcoin trading is legal in Singapore, so that's where it's going right now.
Yeah, and you are seeing a lot of wealth go over to Singapore. Okay, we got to get to the Course Member Live. Thank you so much, everyone, for being here. Thank you for those of you here on Twitter Spaces, and we'll see you in the next